Here's the closing bell for today.
And there you have it, your closing bell there for Monday. Let's take a look at how the major indices ended, all three ending in positive territory. The Dow up more than 400 points, they're up 1.33%. You have the S&P 500 up about 1% as well, about 36 points. And the tech-heavy NASDAQ up about 90 points as well, so green across the board. Well, let's take a closer look at the broader markets with our markets panel. Let's bring in Bryce Doty, SIT Fixed Income Senior Portfolio Manager and Senior Vice President, and David Stryzewski, Sound Planning Group CEO. Good to see you both. So obviously, we're just heading into the midterms here, a little bit of frothiness, but a positive day so far. David, what do you think the markets are digesting right now?
Well, great to be with you. And, the markets today are getting this wonderful bull, what I'm calling a bull bounce or a bear bounce. And, I think it's in anticipation of tomorrow. Obviously, if we understand history, the market likes the idea of getting into more of a gridlock as opposed to just having a unanimous Senate and House and president. And so, based on the election indicators, it seems like there's going to be some adjustment there. And so the market, I believe, is responding positively to that. I don't believe that they're responding positively to Powell last week, who's in a rock and a hard place position here. But, we're looking like there are some challenges here in the future and that there's potentially going to be some pivot. But right now, he's made it very clear that we're not going to be doing that. So what I'm seeing here in the short term, at least, is a nice run leading into this midterm election, and it seems like it can continue here for at least a short midterm until we kind of start facing some of these challenges here that 2023 is going to bring with deficit ceiling conversations, et cetera, et cetera.
Bryce, what do you think about between now and year end? Because seasonally, this is normally a strong period here for the markets. Morgan Stanley, Michael Wilson was saying that U.S. midterms are set to fuel a stock rally. Do you agree?
Well, typically there is a relief rally after midterms. I mean, I don't know about you, but I'm so tired of negative political ads, from all sides. I think it'll just be a nice relief to not have to listen to it anymore. And I think that's half the reason for there's being a bounce after a midterm election or any election for that matter. And I agree that gridlock is good. There's been so much change that occurs when one party is 100% in charge. It's hard for investors to really know where things are at because everything just keeps moving all the time. I also think that interest rates might peak between now and the end of the year. So I'm not as bullish on stocks for next year, but I think bonds are really looking good here because the Fed at 3 3/4 to 4% range on their Fed funds rate, they're a lot closer to the end of their rate hiking period than they were when they began, obviously. And the thing to keep in mind is that they always overdo it. So on that last rate increase, the yields usually go down in the bond market. So you want to prepare for that today. Sometime between now and year end, I think is a good time to be buying bonds.
And David, we know that Goldman Sachs cut expectations for S&P earnings growth for next year and the following year as well, talking about what they saw as a greater contraction in terms of margins in third quarter earnings. How would you characterize the earnings season right now?
Well, earnings are difficult to estimate when times are normal, right? And today we have so many different crosswinds that are taking place right now that I think Goldman Sachs and Jamie Dimon, who says that, we've got a second half of a hurricane ahead of us, that they probably are right on par, given the fact that, we have these challenges in, let's just even say housing, let's say metabolizing the debt here in a higher interest rate environment. One of the concerns I have, and not just saying, bonds in general that are good investment options, I'm actually very concerned about high yield bonds, given the fact that they were, having such, low rate environment where they could borrow, even though they were, quote unquote, the junk version of the bonds. And what's going to take place now when they have to do so at a higher rate when supply chain issues are still challenged out there And, so there's some big things to be paying attention to as we're looking at this. But if we do see those rates rise further, it would be bad for bonds. If they start going down and we hit that pivot point that the other guest is noting here, that would be wonderful. And ultimately, that would be the place and time that we would begin to say, hey, this is where we really want to start allocating back into the market, utilizing some of the cash that we've been sitting on the side with.
Bryce, I'm going to give you a chance to respond to what we just heard from David. So you say you like bonds. What specifically do you like at this point? And also just bringing up what you said just a moment ago, that usually the Fed does overdo it. Have they already gone too far?
They probably have, especially in the housing, as we just indicated, with mortgage rates up over 7%. The typical mortgage payment on a median priced home has almost doubled. It's gone up by 1,000 a month. So those prices are going to start collapsing. So clearly in the housing area, they've really overdone it, and that's going to be very, very painful. Our sweet spot right now is, frankly, it's our own fund. We have an ETF vault with a 1.5-year duration. We're buying bonds at 5.25% to 5.5% yield, and they're all high quality. So we agree to kind of, the high yield isn't worth it right now. There probably won't be a massive default wave, but the yields already reflect that. So, excuse me, we like a 1.5-year duration, 5+% yield. It's a good place to hang out right now when there's not a lot of good options.
David, what about
David,
you? What do you like in today's market?
As far as the market goes today, I've got about 30 different portfolios, so we've got a mixed, on kind of all strategies. Regarding, where some safer places might be to go, it's a challenge today because, the consumer, there's two types of consumers. There's one that wants to avoid a big volatile downturn, and there's the other that's trying to fight inflation. And so, if you try to fight inflation, you got to go risk on right now, but you've got to be willing to accept that downside. Many boomers today, which is who my team works with, are not going to be able to, recover from a massive downturn given just the amount of time that they have left. So the alternative side is that they go more conservative. And so they can load up on bonds. I'm just going to say really be very cautious about that because there are some alternative options, and that would be even one is uniquely is a fixed indexed annuity that's geared towards growth. I've personally never seen a better time to be able to get, real and meaningful upsides if the market does work out, you participate, but more importantly, none of the down if things do continue to have challenges with them. So that's a few options. I think that we're obviously seeing energy has done well. I'm concerned that if we have just even one challenge with refiner or, we get a very cold winter, that we're going to see even more of a crisis here or supply challenge, which is what this is ultimately all about, is supply challenges, not demand challenges. And that would cause, the price to go up again. And so, there's a number of strategies and ways to be looking at this, but, be cautiously optimistic. And specifically for those who are entering or nearing retirement, I would say, it's probably not worth it to be all in right now, giving inverted yield curves and, just all the different crosswinds that we're seeing right now.
Still certainly sounds like you're a bit cautious. All right, David Stryzewski, always great to have you. Bryce Doty, thanks so much for joining us this afternoon.